All right. William Quinn, thanks for coming on the podcast.
Thanks for having me.
Of course, you co-authored the book Boom and Bust, which was published in 2020. I believe your co-author is one of your colleagues named John Turner. The book covers and analyzes 10 or so bubbles in financial markets that have taken place over the last 300 or so years. Can you talk a little bit about your background first and why you guys decided to write this book?
Yeah, so I'm a senior lecturer in finance, or associate professor in finance at Queen's University in Belfast. I completed my PhD here in 2016, and writing the book was the next step in my career. So there was a postdoctoral position, which was established to work with John, and I started working on the book then. My other research is mostly published in economic history journals and some economics journals. It tends to look at investor behavior during bubbles, market manipulation, and just the causes of bubbles more generally, usually from a historical perspective. So I'm an economic historian, first and foremost, rather than anything else. The thinking behind writing the book was that we felt it was time for another history of financial bubbles. The most famous books about financial bubbles are Charles Mackay's Extraordinary Popular Delusions and the Madness of Crowds, written in about 1841. This is very entertaining, but a lot of it is false and covers episodes which we now know are a little bit mythical, like the Tulip Mania. There's also, apart from any concerns about its academic rigor, the fact that it was written 180 years ago, and a lot of very interesting bubbles have happened since then that he didn't have the opportunity to write about. The other was Kindleberger, and Kindleberger's book, Manias, Panics and Crashes, which some of you listeners may be familiar with. It's a very good book, but its first edition was in, I think, 1976. So again, so much has happened since then in terms of the housing bubbles, Scandinavian housing bubbles, Asian stock market bubbles in the 1990s, the dot-com bubble, Chinese stock market bubbles, the crypto bubble, and although we didn't have the opportunity to write about the crypto bubble because we were too early, a lot of this deserved to be written about. There was a lot of research that had been done, very good research on the causes of bubbles that had been done since then, that we felt needed to be covered.
To get definitions out of the way, and it's been debated, as you guys point out in the book, for centuries, but how did you guys define bubble in this book?
So generally, you require two factors to be the case before you'll describe something as a bubble. You need a very large increase in prices, followed by a very large decrease in prices. Price goes up, price goes down, your typical bubble graph. And you need this to have no obvious connection with the value of the bubble asset. So say that this happens in oil markets, as it has very recently, where Russia goes to war with Ukraine, and this causes the price of oil to go up. And then as supply chains adjust, the price of oil falls back down again. That's not a bubble because those price changes are happening for a very clear and obvious reason. For us to call it a bubble, it needs to happen for seemingly no reason or a reason that's very difficult to identify. And this introduces an element of subjectivity, which is what has made the subject of bubbles so controversial in academic finance, because what I think is no good reason or an implausible explanation for why house prices rose and fell in the 2000s, and what someone else thinks is a plausible reason can be completely different. You have different people with different burdens of proof over whether to accept something as a bubble or not. How we tried to get around this was to say, we're going to actually just forget about the second requirement for now, that this requirement that it needs some kind of disconnect from fundamentals. And we're going to look at macroeconomically significant bubbles that were accompanied by the price pattern, so prices go up and prices go down, and also by a promotion boom where you have lots of new companies going to market. And I think for your listeners, the most obvious example of this will be the late 90s in the tech scene, where you have this wave of big internet IPOs and a stock market boom at the same time.
What is the bubble triangle?
So the bubble triangle is based on the fire triangle from chemistry. This is how we describe the causes of bubbles in boom and bust. So if you remember the fire triangle from chemistry, you have three sides. You have oxygen, heat, and fuel. And if all of those three are in place in sufficient quantities, then a fire can be started by a spark. In the bubble triangle, the three sides are marketability, and this is the oxygen. This is similar to liquidity, but very broadly defined. So, how easy is it to buy and sell an asset? There's many dimensions to marketability. So, an asset that doesn't require physical proximity is much easier to buy and sell than one that does. So, something like a crypto token has greater marketability in this sense than trading cards, especially whenever with technology it becomes possible to buy and sell these on an app on your phone without getting out of bed. Also covers things like legality. Once you go back into history, you find that there was a long time when joint stock companies were illegal. Whenever governments were trying to control this, they felt that it was dangerous, partly because of the possibility of bubbles. So legality is an important element of marketability. And we very often see that bubbles emerge in the aftermath of a sudden increase in marketability, which can come from something like the emergence of the internet, which makes buying and selling stock much more straightforward, or from deregulation, which makes assets easier to buy and sell. The fuel then for the bubble comes from money and or credit. So essentially people need to have sufficient disposable income to invest in the bubble asset and inflate the price in this way. If they don't have this, then the bubble isn't really going to get anywhere. And this can be just disposable income in the form of money. An example of this might be the meme stock bubble of 2021, when people found that they had a lot of disposable income because we were in lockdown and there were few opportunities to spend your money. Some of that money finds its way into these very speculative instruments. On the other hand, what credit means is that it can be borrowed money. So something like the housing bubble of the 2000s, all of the money was in the form of mortgages. These mortgages were being issued in order to fulfill this demand for mortgage-backed securities, to fulfill regulatory requirements. And that was what was fueling the bubble in a large part. And then the third side is what we call speculation, which is a bit ephemeral, a bit difficult to define. This is simply the investment strategy of buying something because you think its price is going to go up, without really thinking too hard about what that asset is actually worth. You're not investing because you think it's going to be a good company. You're maybe looking at past price patterns and saying, well, the price went up yesterday, so I think it's going to go up tomorrow, which is a form of momentum trading. Or you think there's a really great story associated with this asset, and you think that's going to get lots of other people very excited about it, and you'll make a lot of money if you get in on the ground floor. Some people can make a lot of money by speculating. Most people tend to lose money, tend to overestimate their ability to make money in speculation. It also tends to be a bit of a zero-sum game or a negative-sum game. Whenever we see a bubble, this is generally what's driving it. This is, at least based on the best available evidence, what's changing that's creating this disconnect between the price of an asset and what that asset is actually worth. So those are the three sides, but you also need a spark. You need the spark to describe why you get a bubble in a particular asset at a particular time rather than in another asset class. So why was it housing in the 2000s rather than tech stocks as it had been in the 1990s? And for this, we say for major historical significant bubbles, the spark has come from one of two places. Either technology, which the most obvious example again is the dot-com bubble, where you get a lot of excitement that these narratives around the technology and how it's going to change everything. You get often very strong returns to early adopters. So if you were in on Microsoft in the 80s, for example, you became very rich and people see this and they copy it and they're trying to find the next Microsoft. So technology is responsible for some bubbles, although those don't tend to be the most concerning bubbles. Those don't tend to be the bubbles that cause the most damage. The bubbles that cause the most damage tend to be sparked by politics. This is where some kind of government policy is what starts causing the price of the bubble asset to rise. Examples of this are the 2000s housing bubble. So government policies designed to extend homeownership and offer mortgages to more people, regulatory requirements that encourage banks to hold, in order to fill regulatory requirements, they had to hold so many AAA rated securities, of which the highest yielding were mortgage-backed securities. A lot of this was explicit. A lot of governments in the 80s and 90s were talking about how, hey, we need to get more people owning houses in this country. We need to encourage home ownership. It makes for better citizens. It makes for citizens that vote for my party rather than another political party. And they say the way we're going to encourage that is by making the banks extend more mortgage credit to these people who were previously thought to be too much of a risk. So that's an example of a politically sparked bubble. And in principle, this can be any kind of policy, a deregulation in a particular area, elaborate scheme to reduce the government debt, which is what happened in France and the UK in 1720. It could be anything.
Yeah, that was definitely one takeaway I had was that when bubbles are sparked by a government policy rather than some sort of technological innovation, those were the bubbles that seem to have larger societal consequences once they burst. And then also, I don't think this applies across the board, but when the bubbles involved real estate or houses, those seem to also be a little bit more consequential on the back end. What are some of the factors that can cause a bubble to burst?
So it's actually very difficult to say why a bubble has burst at a particular time. So you think of the most famous bubble bursting in history is the Wall Street crash. I think people study the Wall Street crash more than they study the Wall Street bubble because it's this dramatic event in American history that produced all of these iconic images, all of these iconic headlines, and is popularly associated with the Great Depression, one of the greatest economic disasters in history. So nobody knows what caused it. There was no obvious proximate cause. It wasn't the case that there was a high profile bankruptcy, there wasn't a bank failure, there wasn't a war. You compare it to the fallen stock prices on the day of Pearl Harbor, for example. Pearl Harbor, I think the Dow Jones index fell by about 6%, and in the Wall Street crash, it fell by about 30% over the course of just a few days. In the absence of any kind of news that would actually cause, on a fundamental level, that level of a collapse. And we see this again and again. What is actually triggering these? We can come up with plausible stories. Well, what triggered the bursting of the dot-com bubble? Well, it wasn't really anything. Or sometimes there's an event that takes place, like a central bank official mentions that they might think about raising interest rates. But they've said this 100 times before, and it hasn't burst the bubble, and it never quite adds up. And at best, you could say it's a bit of an overreaction by markets. It's a very difficult question to answer. It's very rare to see a bubble bursting and be able to say this is the reason that it burst. Usually, I think they just run out of fuel, or one of the sides of the bubble triangle starts to dry up.
Yeah, so running out of fuel could be the number of potential speculators that are fueling the mania sort of caps out, right? Like there's just not that many, there's not more people that can get involved that would keep the bubble going. And then possibly simultaneously, the people that got in early and sort of rode the bubble, they might start to sell and try to capture their profits.
Yes, definitely. So you have these skilled speculators, people who are very good at getting in early and getting out at the right time. Whenever they start to leave, this is sometimes there's some research that suggests that they try to coordinate so that they all try to sell it at the same time so that it actually has the desired effect, so that they're actually making the profit as intended. Because if they're all selling at different times, they'll either earn less profit or possibly sell too late and not make any profit at all. You can run out of fuel, as you say. I think this is kind of a feature of bubbles as they grow, is that they tend to attract more and more new investors. And obviously that there are only so many people in the world who have the money and the inclination to invest in these things. And at a certain point, that the price is going to stop going up because a lot of people are drawn in by this momentum trading strategy, this speculative strategy. And the whole idea is that the price is going up. And once the price isn't going up anymore because you run out of new investors, there's a bit of a Wile E. Coyote effect, right? Where you look down and see that there's nothing below you, and that's when the market starts to fall. So yeah, I think that's a big part of it. Although that doesn't make them necessarily that much easier to predict when they're going to burst, because it's very hard to see how many more people are going to get involved.
What are some of the considerations or trade-offs that governments have to make when they think there's a possible bubble happening and they're deciding whether or not to prick that bubble?
Yeah, so that's a great question. I think To sort of wind this back to why would they want to burst a bubble? Well, the main reason is that they would worry that it would have macroeconomic effects whenever it burst. And macroeconomic effects, the vast majority of these come from bank failures. The big question that you want to answer, first of all, is are the banks exposed to this bubble? Sometimes these links are obvious, something like the housing bubble. Obviously, banks are lending enormous amounts of mortgage credit. They're going to be in trouble if there's a downturn in the housing market. That said, not so many people spotted that this was going to be the case at the time, but the facts were there to be found if you were looking for them, or if you were in a bank, or if you were regulated in a bank, you had access to enough information to understand that. At other times, and I think that the crypto bubble is a really clean example of this, the banks aren't exposed at all. You just know by the nature of the asset, and by the fact that a very large number of banks avoided cryptocurrency altogether, and those that did hold it held it in very small amounts. It was quite clear to see that whenever cryptocurrency fell, whenever lots of losses were experienced in various parts of that industry, it wasn't going to lead to any bank failures. And we did actually have Silicon Valley Bank, Silvergate Bank collapsed around that time, but it wasn't a direct result of the crashing of the crypto bubble. There was other things going on whenever those institutions failed. So that's the first thing that regulators want to look at is like, what are the consequences of this bubble going to be? If it's a bubble that the banks aren't exposed to, the only thing that a government needs to worry about is investor protection. So are people being misled? Is there any fraud going on? There's usually some fraud going on in conjunction with a bubble, but they don't need to worry about protecting the economy from the bubble. They can let it run its course insofar as there isn't any illegal or fraudulent activity taking place. On the other hand, if the banks are exposed, one suggestion is that you might want to try to burst the bubble by raising interest rates. If you have lots of banks that are very exposed to this bubble, then that might just cause a financial crisis or immediately trigger a financial crisis. And this is actually a rough approximation of what happened in 1928 and 1929. The Federal Reserve saw that Wall Street was in a bubble, that they tried to raise interest rates in order to curb some of the stock market speculation that was going on. And this didn't actually affect the bubble. The bubble continued to grow as interest rates increased, but it did cause a lot of problems for a lot of vulnerable banks. So that's maybe not necessarily a good idea. What I think is the best policy solution here is to examine these interlinkages between the bubble and the banks. Just make sure that regulation to prevent bank failures is doing what it's supposed to be doing. Now, a lot of the time, the government is actually responsible for the bubble. The bubble has political roots, so you're asking them to mark their own homework in a sense. But I don't want to be too cynical here because you do have serious people working very sincerely at federal institutions and regulatory institutions who genuinely do not want a financial crisis to take place. What they need to worry about with a bubble is what's going to happen to the banks whenever it bursts. And to the credit of US institutions specifically, they really have got serious about this in the aftermath of 2008.
On a similar note, what role does the media play in either fueling or pricking bubbles? And to some degree, is the media in sort of a tricky position there?
Yeah, I think that this is quite difficult to examine. It's always difficult to examine the role of the media. To what extent is it causing a change in public sentiment? And to what extent is it just reflecting a change in public sentiment? And it varies across time. We have instances where the media seem to be doing a pretty good job of identifying that there was a bubble, giving good advice to investors on which asset classes that they should stay away from. And then we have instances where the media was really on board with the bubble, probably fueling the bubble, reporting on it in a very uncritical way. What I really noticed with crypto markets, and this was something that came from living through bubbles rather than through my own research into bubbles, I really observed that the narrative in the news media is very much determined by the price. So that the price of Bitcoin goes up and you get this wave of very positive coverage. And then the price of Bitcoin goes down and you get a wave of very negative coverage. But this was strange to me because the nature of the asset hadn't actually changed. It was still, what it was. If you thought it was an effective currency before the price went down, then you would still think it was an effective currency afterwards. If you disagreed, if you had problems with it and its use in illegal activity, again, not affected at all by its price. But this was maybe reflective of demand. Whenever the price of Bitcoin went up, people wanted to read really exciting stories about people becoming billionaires through their early investments in Bitcoin. And whenever the price goes down, people want to read about fraudsters and find a villain or a scapegoat or someone to blame.
Yeah. Do you think the efficient market hypothesis can coexist with the reality of bubbles?
Yeah, I do. Yeah, I think the efficient market hypothesis can't possibly be exactly true, because if markets were fully efficient, nobody would ever try to correct mispricing. And if there's nobody to correct mispricing, then prices can't be efficient. And this was well understood by Fama, the people who came up with the efficient markets hypothesis, that they fully understood some of the limits that were placed on it. And like any theory, it's never going to be exactly true. The saying that all models are false, but some are useful. The same is true of the efficient markets hypothesis. I think one of the things that it misses is the existence of bubbles. But what you asked is, can it coexist with the existence of bubbles? And I interpret that question as meaning, is it still a useful theory? Is it still a useful hypothesis? And I think that it is. And the reason I think that it is that 95% of investors would earn better returns if they followed the efficient markets hypothesis instead of whatever it is they're doing instead. And the world is catching up with this reality. They're investing in tracker funds rather than trying to pick their own stocks, for example. And it's only a minority of people who are able to make better investments than that. I know you're in venture capital and it's your job to do better than the efficient markets hypothesis would recommend, but you can't deny that it's a useful theory for investors. And if I'm giving investment advice to someone who has no experience in finance whatsoever, that's exactly the advice I would give. Is like, yeah, just don't worry about it, but buy tracker funds and you'll do better than most of the people who are involved in finance.
That makes total sense, and I agree. It is. I think the most important thing, or one of the most important things, is that people understand the risks and understand the data, and to some degree, the low likelihood that exists of beating the market. And I'm not sure if everyone out there fully grasps that, just because they may not have been exposed to the data. That leads me to a question. This is more of a thought, and I'd be curious to hear your reaction. It dawned on me that a lot of the speculators across these different case studies were directionally correct. Whether it was excitement about bicycles or Mexican mining companies or land in Australia, they had legitimate reason to be excited. They put some money behind their beliefs, buying securities in certain companies, but the securities let them down because they maybe weren't structured in a way that could deliver value in the way that the investors were hoping. What do you think this says just about a cautionary tale in terms of trying to put money behind excitement around what is probably objectively a very exciting new frontier?
Yeah, it's a great question. So I noticed this when I was looking at commentary on the dot-com bubble. You look at late 1999 when the dot-com bubble was nearing its peak. What types of conversations were happening around the value of internet stocks? What I noticed was that rather than looking at, is pets.com actually worth this many billions of dollars? Quite a technical question, a highly quantitative question that you need some specialist expertise to actually answer, maybe some information that you don't have access to. Rather than talk about that, which was kind of dull, people would much prefer to talk about how exciting is the internet? How big is the internet going to be? How transformational is the internet going to be? And this question about the power of the internet almost becomes a proxy for dot-com stocks. That if you think the internet's going to be huge, you want to invest more in dot-com stocks. And if you're a bit of a skeptic about the internet, you don't want to invest in those stocks. But value in stocks is a quantitative question, right? You can think this company is worth $10 billion, but if the market valuation is $15 billion, it's still a bad investment. And I think that this was the case for a lot of these dot-com companies. It was, as you say, directionally correct, but quantitatively incorrect.
Yeah. In reading the cases, it was one of the sort of sad elements of bubbles is that you have a large group of people that have a belief about where the world's going. They are correct in that belief, but the securities just don't exist for them to put money behind that belief in any sort of reasonably responsible way. And it's not their fault. It's, they should, to your point, they should do the quantitative analysis of those securities. But I can also understand someone's desire to put money behind a sort of very long term belief of where the world's going. Okay, so when bubbles burst, they don't always burst quickly. In fact, a lot of the cases, the pace of the bursting can be very different. What are some of the factors that can play a role in how quickly a bubble bursts?
So the main one historically is the extent to which the bubble was driven by borrowed money. And this is particularly true of stock market bubbles, because whenever you have a credit driven stock market bubble, it's margin trading, right? So you're borrowing money to buy these stocks, but they're in a margin account. And if the price falls a little bit, you have to make up that difference by providing more money. And sometimes in order to get that more money, you have to sell other stocks or other investments. So then the price of those investments falls, and this puts pressure on other margin traders. And you enter this downward spiral of liquidations of margin traders and falling prices. This is what happened in 1929. It's also what happened in China in 2015. These are the two stock market bubbles which were most driven by margin debt. When we're comparing then stock markets and housing bubbles, I think with housing bubbles, although they are driven by borrowed money, there are liquidity effects. House prices tend to be quite sticky. So the first sign that a housing bubble is bursting generally is that the quantity of sales completely dries up, because people don't want to sell the house for less than it was going for a month ago, but there are no buyers. So they just hold on to the house, and then prices then start to fall more gradually. That's what we see historically. I think more recently, bubbles will, and look into the future, I'd expect bubbles to burst more quickly than they have in the past, just because the news cycle is so much more rapid. I think that
Yeah.
this wave of excitement and euphoria about an asset, followed by skeptics coming in and fear that there's a bubble going on, and then the money drying up. It's going to happen much more quickly, because in every part of our lives, the news cycle happens a tiny fraction of the pace, or a tiny fraction of the time that it used to happen. So something like NFTs, for example, they're here and then they're not here. The whole thing is begun and it's over within a matter of months. I think that's where we're headed. I think they're going to grow and burst more quickly than they used to.
Yeah. On a similar note, why have bubbles been occurring more frequently in history over the last 50 or so years?
Great question, too. So I think this ties to the marketability side of the bubble triangle and the money side of the bubble triangle, because what's happened in the past 50 years is financial globalization. I'm of a generation where I don't remember Bretton Woods or anything before about 1995, but sometimes forgotten that this was an era of capital controls, where in many countries, such as the UK, if you wanted to take money out of the country, there were heavy restrictions on that, similar to those in place on China today. And as part of financial liberalization with the Thatcher government in the UK, the Reagan government in the US, and this was sometimes called the neoliberal revolution, although it's a bit of a loaded term, the ability of, first of all, banks to do whatever they wanted, that the amount of regulation on who banks could lend to, how much risk they could take, was stripped away. And also the ability of money to flow across borders increased exponentially. So now if there's some excitement in one part of the world, say Thailand in the 1990s, it's very easy to attract money or fuel from all over the world in a way that wasn't possible in previous eras whenever there was some level of financial repression. More recently, an asset like crypto is fully globalized. It just doesn't have a set location. Again, it can attract money from anywhere in the world and attract money very quickly. Information is spreading much more quickly, so lots of people are hearing about these new speculative investments sooner than they were. Interest rates are lower, an era of historically low interest rates, partly as a consequence of all of this financial liberalization. It's easier to borrow money if you want to invest in bubble assets. I think that this all comes back to these sides of the bubble triangle and this move from an era where there were heavy restrictions on finance to one where money can flow very easily across borders. Banks can lend to whoever they want, broadly speaking, and so on.
Do you think that we are in an AI bubble right now? And based on the framework you lay out in the book, I think I know what your answer would be, but I'll let you go first.
I haven't done the quantitative work. I don't want to fall into the trap I talked about with the dot-com investors, where it just becomes a kind of a referendum on what I think the potential of AI is. But what I would say about where we are at the moment is that interest rates are quite high. So you wouldn't expect an enormous amount of credit or reaching for yield to be going on that would drive overvaluation in AI companies. So I think if there's a bubble there, it might have some way to go. I think the technology is real. So I suppose I should be more specific about that. I don't think large language models are a step towards general AI. I'm skeptical about that. I don't see how you get from one to the other. But I do think large language models are incredibly useful and monetizable. On the other hand, there will be a lot of companies that are using AI to raise a lot of money from venture capitalists, especially. And when you look under the hood, there's not actually any AI going on in there. Maybe it's they're repurposing ChatGPT and adding some kind of user interface on top of that, or maybe they're doing some machine learning but doing it very badly, and they're not actually going to be able to make any money out of it. In that sense, you could say some of these companies are going to be in a bubble, but the industry as a whole, I don't think it's the case that all of these companies are going to be overvalued. I think there are going to be some very good companies involved in AI that aren't overvalued, at least not yet, as well.
The point about interest rates and just the money supply right now, when I said I think I know what your answer would be, it was that just not all three sides of the bubble triangle are in place because there hasn't been some massive increase in the money supply. The spark may have been ChatGPT coming out, but that hasn't coincided with some big increase in credit or something like that. And then I would be curious to hear your thoughts on marketability in AI right now. There's not that many, or there hasn't been some massive increase in at least public AI companies. There definitely is in the private markets,
Yes.
but at least in the public markets, I think because there's not that many sort of kind of AI companies, a lot of the value has gone to NVIDIA.
Yeah, that is curious. Yeah, so there's other research into bubbles suggests that another necessary condition is pure play firms, where you have a company that you can invest in that's concentrated in a new technology. With something like electric vehicles, for example, for a long time, electric vehicle technology existed, but it was within existing car companies. And the way to bet on it, well, there was no way to bet on it until Tesla comes along. And now it's like if you're very optimistic about electric cars, you can bet in Tesla. You're right that NVIDIA seems to have really attracted a lot of money that's excited about AI. The curious thing about NVIDIA is that it is making a lot of money. Usually these early stage tech firms, if we can call it early stage, are either hemorrhaging money or not making a lot of money, whereas NVIDIA can both appeal to future growth and seems to be making a lot of money in the present. So I can understand why people are excited about it. Should it be the most valuable company in the world? I'm not so sure, but as you correctly predicted, we have fairly high interest rates, and I'm not really in the business of calling out bubbles just at the moment.
Yeah. From data I've seen, I think NVIDIA has actually not deviated from historical fundamentals that much, as opposed to some other analogs that people like to point out from the dot-com bubble. We should try to end on a positive note. How can bubbles be useful in society?
The main feature of bubbles, which is useful, is that they tend to occur in very innovative sectors of the economy. So remember, one of the sparks is new technology. So something like the internet in the 1990s or AI today, even. or electric vehicles, so other asset classes which have appeared to be in a bubble in the very recent future. And what you're saying, whenever you say that those areas are in a bubble, is that they're overvalued, that people are investing a lot of money in these companies at very high valuations. But what that looks like from the company's perspective is that they're finding it very easy to raise money. So another way of saying, oh, we're in an internet bubble is, look, it's really easy for internet companies to raise loads of money for very low valuations. And in a sense, this is correcting a problem with capitalism, even. A problem with capitalism is that there's a discount rate, and a lot of the most socially beneficial technologies is only going to produce a return far into the future, when if you're discounting correctly and using your cash flow models, you'll very quickly decide that investing in research development, especially with the associated uncertainty, is a bad idea. But what we have with bubbles is that if you're doing lots of research and development and people are very excited about that, they're actually going to give you more money than your company is theoretically worth. And that's potentially a good thing for society, maybe a bad thing for those investors. Or maybe, I think more recently, a lot of investors actually understand that they're happy to own the stock of a company that they think is doing some very good and interesting and socially beneficial work, even if that stock might be a little bit overvalued. And so this is, I think, the main way in which a bubble can be socially useful.
William Quinn, thank you so much for doing this. Really enjoyed your book. I recommend it to every investor out there. And yeah, thanks for coming on to talk about it.
Yeah, thanks for having me.